Over the past year, Qualcomm is up by 17.50%, but after reporting their earnings yesterday, the stock price of the company fell by 3.72%, even though they reported a beat of their earnings per share by 44 cents and beat their revenue by 770 million, with the guidance in line with the analyst expectations. So why did the company fell in price? Well, investors are mainly concerned over the lower demand for new smartphones. So jumping to my stock valuation spreadsheets, let's plug in Qualcomm's ticker and all the metrics will show up automatically. And the first thing I want to point out is Wall Street's target price sitting at $203, which is about 20% higher than the current stock price. So in fact, when we jump to my 9-pillar analysis, you can see that all the pillars are sitting in the green and the company gets a rating of 9 out of 9. Now the 9-pillar analysis is a simple way to analyze a stock's fundamentals and figure out if you should be adding the company in question to your portfolio. So first, let's have a look at Qualcomm's financial growth. Their 5-year revenue CAGR is actually sitting quite low at only 5.19%. Their 5-year net income CAGR is sitting a little higher at 8.65%, and their 5-year free cash flow CAGR is sitting at 12.64%. Now, if I zoom into pillar 3, you can see that indeed the revenue hasn't increased by much over the past 5 years. That is the same case with the net income, but when we have a look at the free cash flow, that is increased from 8.6 billion in 2020 to 12.7 billion in 2024. That's a 50% increase. And in fact, by looking at the historical free cash flow growth, we can predict the future free cash flow growth and calculate the intrinsic value of the company based on that. So jumping to my discounted cash flow model, we will plug in the free cash flow of the company over the past 5 years and calculate the average growth rate to be sitting at 12.64%. Now into the future, I will predict the high growth at 11%, the medium I will go with 9%, and low I will go with 8%. And after averaging this out, I will get a calculated growth rate of 9.3%. I will then use this to calculate the future free cash flow. Now, to calculate the present value of that future free cash flow, I have to plug in a discount rate. And to do that, I will plug in my high year-over-year desired return at 12%. Medium, I will go with 10, and low, I will go with 9. And that will give me a discount rate based on the WACC of the company. And after using this discount rate to calculate the present value of all of that future free cash flow, I will sum all of it up, add cash and cash equivalents, and subtract total debt to get an equity value, which I divide by the shares outstanding and get an intrinsic value of $218.67, which is higher than the current trading price. So based on the free cash flow growth of the company, we just calculated its intrinsic value. But let's jump back to the 9-pillar analysis and have a look at some more metrics. The first thing I want to point out is the company's 5-year PE ratio and their 5-year price to free cash flow ratio, which are both sitting nice and low, which would mean that the company is trading at a discount. Their 5-year PE ratio is sitting at 15.59. Now, if we zoom into pillar 1, you can see that currently it is sitting higher at 18.92, but that is still in the range we would like it to be in. And that is the same case with the price to free cash flow, which is currently sitting at 17.40, higher than the 5-year average, but in the range we like it to be in. So obviously, seeing the price to earnings and the price to free cash flow multiples sitting this low means that investors are underpaying for the company's earnings and for their free cash flow. And actually, we can jump to the multiples valuation where we can compare Qualcomm to its competitors. So when I plug in Micron Technology and Texas Instruments, take these companies' current stock prices and divide by their earnings per share, we will get their PE ratios, which are both higher than the PE ratio of Qualcomm. So when I average them out and multiply by the EPS of Qualcomm, we will get an intrinsic value of $280.71, much higher than the current trading price. Now, if you have made it so far into the video, I just want to let you know that I have started teaching investing in online one-on-one sessions. So if you have just started investing and have questions or simply want to learn all about stocks and the stock market, how to value them, when to invest, and which metrics mean what and why they are important, you can sign up by going to the link in the description. We are currently running a 20% discount. Now, there are 3 things I really like about Qualcomm: their 5-year profit margin, their 5-year dividend CAGR, and their long-term liabilities over the 5-year free cash flow. First, looking at the 5-year profit margin, you can see that it is sitting nice and high at 25.67%. And if I zoom in closer, currently it is actually sitting slightly higher than over the past 5 years. Now, regarding the dividends, if I jump to pillar 8, the 5-year dividend CAGR of Qualcomm is sitting nice and high at 4.78%, with their dividend yield sitting above the average of 1.83%. Now, the thing I really love about Qualcomm's dividends is their 5-year free cash flow payout ratio, which is sitting at 34.74%. But if I scroll down, you can see that over the past 5 years, it has actually been decreasing, and currently it is sitting at only 29.32%. Which means that the company does have the means to increase their dividends into the future by quite a bit. And finally, let's have a look at the company's long-term liabilities over the 5-year free cash flow negative dividends, which is sitting at 0.76, and means that Qualcomm wouldn't have an issue paying off all their long-term liabilities with the free cash flow they currently generate and while paying out their current dividends. So overall, after going through the 9-pillar analysis, the company looks like a very safe investment that will grow into the future. And as I always like to be transparent on this channel, I currently do own Qualcomm in my personal portfolio. Now, to calculate its intrinsic value, let's jump to the grams formula advised, where I will plug in the high earnings per share growth estimate at 12% into the next 5 years, medium at 10 and low at 9. I will then average this out with the analyst predictions and take all these 6 values, plug them into the grams formula and get an intrinsic value of $178.34, which is 5% higher than the current trading price. And by the way, if you want to download these sheets for your own personal use, you can always do so at the link in the description. Now, we have already gone through the discounted cash flow model and the multiples valuation model, so we have one more model to go through, and that is the dividend discount model. So we will plug in the dividend growth rate of Qualcomm over the past 5 years and calculate the average to be sitting at 5.97. Now, into the future, I will predict a growth of 8%, medium I will predict at 7%, and low I will go with 6%. And as you can see, the intrinsic value will come out quite low at only $108.09. And now finally, moving to the ultimate valuation, we will average out the 4 valuation models and get an intrinsic value of $196.45, which is 16% higher than the current trading price, and with a margin of safety of 10%, we would get an acceptable buy price at $176.81. And if I plugged in the margin of safety at 15%, we would get an acceptable buy price at $166.99, which actually Qualcomm was trading at about half a month ago. And with that, let me know down in the comments what you think about Qualcomm, if you are buying, selling or holding, and make sure to leave a like and subscribe as it really helps me out.